If we tax rich people, they'll just leave, right? Well, that's exactly what many people fear, and it's not entirely baseless. But what does the data actually say? And could that fear itself be making us miss smarter ways to raise revenue? Let's dig in. Imagine this. You raise the taxes on the richest people in your city, the ones who run big businesses, hire a ton of people, and invest a lot of money. Immediately, the argument goes, they pack up and move somewhere friendlier to their wallets, taking their money, jobs, and businesses with them. If that happens, you don't just lose the extra taxes you hope to collect. You could actually make things worse. Sounds dramatic, but this idea isn't new. It's called capital flight, or sometimes more specifically, tax flight, the wealthy shifting their residence, their money, or both, to places with lower taxes, and it's become a hot topic again, especially in places like the UK, where high net worth individuals are reportedly heading to Dubai, Switzerland, or other low-tax hubs. But would their leaving actually be that damaging? Is the fear of a millionaire or billionaire exodus a real economic doomsday, or more of a political scare story? Let's unpack this. First, what's actually happening right now? According to the 2025 Private Wealth Migration Report by Henley & Partners, a record 142,000 millionaires are expected to relocate around the world this year. That's historic. And when you look at the big picture, the UK is projected to lose 16,500 high net worth individuals in 2025, representing roughly £66 billion in investable assets. Why are they leaving? One major reason: tax. In the UK, there's been a flurry of reforms: more capital gains tax, changes to inheritance tax, and the abolishment of the long-standing non-domiciled, non-dom tax status for some wealthy residents. For many millionaires, this shifts the math on whether it even makes sense to stay. Some high-profile examples reinforce the point. A billionaire reportedly left the UK the very day tax breaks were scrapped, boarding his private jet with family and tutor. Meanwhile, banks are sounding the alarm too. The CEO of Royal Bank of Canada warned that a potential 2% wealth tax in the UK could drive more ultra-rich people away. So, yes, there is some movement. But here's where it gets complicated, because not everyone agrees on how big the problem really is. Critics argue that the millionaire exodus narrative is massively overblown. The Tax Justice Network, for instance, reviewed Henley & Partners' data and found something surprising. The number of millionaires reportedly leaving represents almost 0% of the total millionaire population in those countries. In other words, while headlines scream exodus, most millionaires are staying put. And that's backed by more than just press releases. Research shows that for the very wealthy, relocation is only one factor in their decisions. Yes, taxes matter, but so do family, business roots, social ties, and homes. According to interviews done by economists, many high net worth individuals don't just uproot their lives solely for a slightly lower tax rate. Another layer: how much revenue can a wealth tax really bring in? The Tax Foundation argues that wealth taxes often yield very little revenue, and they carry big risks, and even modest increases in wealth tax rates might lead to real capital reallocation, but not always dramatic mass migration. For example, a study from Switzerland showed that reducing the top wealth tax rate by just 0.1 percentage point in a canton led to a measurable shift in the wealth share of the richest over 5 years. Then there's profit shifting by corporations, which complicates things even more. Big multinationals often route profits through tax havens to minimize tax liability. So even if you tax the rich locally, global structures may allow some of that money to slip away, not by relocating people, but by relocating profits. In short, the doomsday scenario makes for great headlines, but the economic reality is more nuanced. Now, you might think, okay, if the risk is real but not catastrophic, why not just steer clear of taxing the rich too aggressively? Because here's the punch. Raising taxes on the very wealthy isn't just about raising revenue. It's also about fairness, redistribution, and funding public goods. And the question we need to ask is whether the potential gains on one side outweigh the risks on the other. That brings us to the heart of the debate. When we say, if we tax them, they'll leave, are we really making a practical economic prediction, or are we wielding a political threat? Let's get real about capital flight. It sounds scary. Rich people fleeing, emptying cities of money, jobs, and businesses. But the truth is, the effect is often smaller than you might imagine. Take the UK again. Yes, some ultra-wealthy individuals are leaving, but the overall tax base remains surprisingly robust. According to the Office for National Statistics, while thousands of high-net-worth individuals departed over the past decade, the top 1% still contribute nearly 30% of income tax revenue. ons.gov.uk. In other words, even if a few billionaires fly away to Dubai or Miami, the tax system doesn't crumble. Why? Most wealthy people are sticky. They own property, run businesses, and have families deeply rooted in their home countries. Moving isn't just a plane ticket. It's uprooting a lifestyle, networks, schools, and careers. For many, the inconvenience outweighs the tax savings. That's why studies show that even modest increases in top income tax rates often cause only minimal relocation. taxpolicycenter.org. But that's not the whole story. Where we see real financial movement is among those who are mobile and globally connected. Tech entrepreneurs, hedge fund managers, and certain executives. They can legally shift residency, bank accounts, or even business headquarters to lower tax jurisdictions. This is why places like Miami, Dubai, Singapore, and Switzerland have become magnets for the mobile rich. They offer favorable tax regimes, strong legal systems, and high living standards. And it works. Florida's population of millionaires increased by 22% over the past 5 years, partly fueled by movers from high-tax states like New York and California. Forbes.com, New York City, now jokingly called the Socialist People's Republic of NYC in some financial circles, risks losing both residence and economic influence if taxes climb too high. So what happens if they leave? It's a mixed bag. Economists call this the Laffer curve effect. Beyond a certain point, higher tax rates can reduce total revenue because they discourage income generation or drive it elsewhere. But the curve is not a universal doom. It depends on how mobile the wealthy actually are. Some historical examples are illuminating. In the 1970s, France introduced very high top income taxes, and some wealthy individuals relocated to Belgium or Switzerland, but the exodus was relatively modest in scale, and France still collected substantial taxes from its wealthy residents. Conversely, when Estonia cut corporate taxes to zero on reinvested profits, it attracted new business investment, creating jobs and expanding its tax base indirectly. Here's where it gets tricky. Capital is fluid, but human capital isn't always. A billionaire might move her money to Dubai, but her employees, her factories, her customer base, they mostly stay. That means the local economy doesn't vanish entirely, even if tax revenue shifts somewhat. Another angle, governments can design policies that encourage retention rather than purely punish wealth. Think tax credits for domestic investment, exemptions for certain kinds of income, or residency incentives. Singapore does this well, offering tax benefits for high-income earners and entrepreneurs while maintaining a thriving local economy. Singapore.gov.sg. Then there's the question of global competition. If every rich person leaves a high-tax country, the world loses economic engines in those areas. But if a country can strike the right balance, fair taxation, strong public services, and smart incentives, it can both raise revenue and keep the wealthy contributing. We also have to consider public perception. Politicians often argue that tax the rich and they'll leave as a deterrent. But sometimes the rhetoric outweighs the reality. Data shows that most ultra-high net worth individuals are not fleeing en masse, and many are willing to pay higher taxes in exchange for political stability, legal certainty, and quality of life. So where does that leave us? On one hand, aggressive wealth taxes or income taxes can prompt relocation for a minority of the richest and most mobile. On the other, the majority of rich people are not as footloose as headlines suggest. And even if they are, smart tax policy can mitigate risks while still funding public services and infrastructure. So, what happens if the richest among us decide to pack up and leave? Would it really be catastrophic, or could it even offer unexpected opportunities? Here's the ironic truth. The fear of rich people leaving sometimes overstates the problem. In practice, only a small portion of the ultra-wealthy are mobile enough, willing to disrupt their lives, and motivated enough by taxes alone to actually relocate the rest. They stay because business, family, and lifestyle anchors weigh far more than a marginal tax hike. Even when capital flight does happen, it's not always a total loss. Take the UK example again. Yes, some millionaires are moving to Switzerland or Dubai, but many leave investments, businesses, and employees behind. In other words, the local economy doesn't evaporate. It just adapts. Jobs remain, production continues, and in some cases, new local investors step in to fill gaps left by departing elites. Another point often overlooked. Taxing the wealthy isn't purely about revenue. It's also about redistribution and fairness. Funding schools, hospitals, and infrastructure benefits everyone, including entrepreneurs and small businesses. A well-designed tax system can raise money without triggering mass exodus, especially when paired with incentives for staying and investing locally. Look at countries like Singapore or Switzerland. They maintain competitive tax rates while offering stability, quality of life, and smart incentives high-net-worth individuals might pay taxes. But they also contribute to thriving local economies that make their wealth grow. It's a balance, attract and retain, rather than simply chase revenue at any cost. There's also a political angle. Headlines warning rich people will leave if taxed are sometimes leveraged as a threat, a tool to shape policy debates. But if policymakers dig into the data, they see that smart taxation and retention strategies can coexist. Governments can collect revenue, maintain fairness, and avoid driving away the very people who generate jobs and innovation. Ultimately, the key takeaway is this: we can't assume that taxing the rich automatically backfires. The reality is nuanced. Some will leave, yes, but many will stay. And with careful policy design, incentives, stability, and transparency, countries can balance equity and growth. So, would it be bad if some rich people left? Maybe, but probably not as bad as the headlines suggest. And ironically, trying to squeeze every last dollar without strategy could make the problem worse. The smartest approach isn't fear. It's understanding incentives, mobility, and human behavior, then crafting policy accordingly. The debate isn't simple, but it's crucial. How we tax the wealthy shapes the economy, society, and opportunity for everyone. And while the stories of billionaires fleeing to Dubai or Miami grab headlines, the data shows that most rich people are not going anywhere without good reason. So, next time someone says, "If we tax the rich, they'll leave," remember, it's not a blanket truth. It's a complex dance of incentives, choices, and consequences. The reality is that thoughtful taxation can raise revenue, fund services, and even keep the economy humming without sparking a mass exodus. If you found this discussion insightful, hit like, share your thoughts in the comments, and don't forget to subscribe for more deep dives into finance, economics, and the real forces shaping our world. And check out our other videos. There's a lot more behind the headlines than you think. The rich may think they can leave, but good policy ensures that the economy doesn't have to follow.